Good morning. Welcome to
Morning.
episode 38, Monster Comeback. It's Sunday, March 27th, 7:11 a.m. Good morning to you, Wawi.
Good morning, Mark. How are you?
And good. How's it going, Wawi?
Pretty good.
All right, good morning. And good morning to our listeners. I hope everyone is safe. This is your host, Mark Yu.
And Wawi Santos.
And welcome to the Mark Yu and Wawi Show. A disclosure: this show is made for sharing information purposes only and not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing in the stock market. To our co-workers in the medical field, thank you guys for your hard work. For those who have missed it, episode 37 is out. Stay resilient. In that episode, we review the weekly sentiments, which we're gonna do in a little bit. Fund flows and real estate trends. In our roll the clip segment, where we play Wall Street interviews, we played the clip on Tom Lee, Fund Strats, and Charles Schwab's Lizanne Saunders. Thank you guys for supporting. And now for this episode, we're gonna jump on right away to our weekly sentiment and flow segment. So this will be including our weekly discussion of the flows and sentiments, and as well as some snippets from business newspapers. So for the first clip, it says here, stocks cap largest 2-week gains since late 2020. This was a news article that was published just a couple of days ago. For the week, we have logged the best gains, Wowie, incredibly, after being in a dire spot with really bearish sentiments. Bearish meaning negative sentiments about the stock market, people thinking that the stock market will go down. But instead, the stocks overall posted the biggest 2-week gain since the late 2020 or the COVID year or COVID lockdown year,
Mm-hmm.
which is, hopefully everyone benefited from it. How about yours, Wawi?
Yeah, I definitely benefited from the 2 week run up. Um, Looking at my technology stocks,
Mm-hmm.
it ramped up. So it just reflects the underlying bullish sentiment of individual investors like me.
Mm-hmm. Stay bullish. I think I remember just a couple of weeks ago, not bragging, but I think that's when we posted our podcast entitled "Sit Tight, Buttercup," and
Mm-hmm.
since then the market rallied. And that during that time we were thinking about if the market would hang on to being neutral to at least bullish after Jerome Powell signals or provides the basis point hike, the Fed rate hike, and market did. So for
Mm-hmm.
the sentiments, American Association of Individual Investors, we take a look at this on a weekly basis. They publish every Thursday or Wednesday sometimes. For this week, March 23rd, bullish investors came back roaring from 22.5% the previous week. We are now at 32.8%. Still a little low than historical average, but really up, at least higher than a month ago, where we were at down as low as 19%. Bearish investors, or those who think that the market will go down, has dropped from almost 50% of the survey to 35.4%. For the volatility for the past week, we are looking at the downdraft on the volatility, not so much up and down ride as reflected in the stock market. The market is up, so the volatility is down 15% for the S&P 500. For the Nasdaq, still a little bit volatile, but overall negative 5.6% for the week. And if we're gonna take a look at the three major indices here in the U.S. stock market, Dow Jones is up 0.39, S&P 500 is 1.53%, and Huawei's favorite, nah, me and Huawei's favorite, Nasdaq plus 2.08%, which consists of mostly tech companies. Excuse me. For since the start of the year, though, Nasdaq is still down 9.9%, S&P 500 down 4.96%. Dow Jones down 4.2%. So overall, this is a snapshot from Bank of America research. Overall, the outperforming country since the start of the year is, interestingly, Brazil, followed by South Africa, Turkey, and Australia. Meanwhile, the worst performing indices, I would say, of course, is Russia's, followed by Germany, which is down 14%. So if you have investments in Germany, you probably are still in the red at this point in time. Followed by Italy, China, France. So the bottom quartile for sure are from the European companies. I mean countries. US stock market is close to the low end of the range at negative 6.8% as a total. So for the past week alone, interestingly, if we're gonna take a look at the performance, energy is still number one for the past week, up 7.8%. And if we're gonna look for technology, even though Nasdaq performed pretty good this week, it returned 1.74%. Easily beaten by basic materials, which also known as commodities, which we're gonna take a closer look in a little bit, followed by utilities, communication services. The worst performing sector for the week is healthcare. Interestingly, this was being reviewed by one of the Wall Street pundits who is really good at analyzing markets, and we're gonna roll that clip in a second. So just keep that in mind. Since the start of the year, so we now have at least four sectors in the positive territory. Not so long ago, there was only one, which is energy. Currently, is now up 32.88% since the start of the year. So if you have oil investments in your portfolio, congrats to you. If you have Exxon, Chevron, Devon, Shell, well, those are European companies, but Pioneer, British Petroleum, yes, another European company. Those big oil companies have definitely rewarded their shareholders this year, secondary to high oil prices. Followed by basic materials, which are the commodities. It's up 8.5% as a sector. Utilities, 1.64%. Financials, finally turning positive, 0.87%. And the rest are down in the red. Technology is the second worst performer since the start of the year, negative 11.32%. All right, we're going to take a look at the options market, the tail that wags the dog. Put call ratio. Put is still trailing high, a little bit less higher than a couple of weeks ago, but still above 0.9% or 0.9 points. The fear and greed index. Currently, we're now at neutral, 46. Wow. Whereas just a month ago, we were in extreme fear at 21 points, deep in the red. Nobody thought of wanting to buy stocks at the point in time, I guess, during that survey. The fear and greed, obviously, in the chart, it has bounced back up to neutral. This is one thing that we're going to add moving forward, safe haven demand. So outperforming bonds. This is the closest to the strongest performance for stocks relative to bonds in the past 2 years, and indicates investors are rotating into stocks from the relative safety of bonds. So interestingly, safe haven kind of reflects what's going on in the stock market and the bond market. That's where take a look in the following screenshots that we have in this slide. So S&P 500, another thing that we're gonna add moving forward. I think this will be beneficial. This is the advanced decline ratio. So usually this kind of reflects if there's any momentum behind a rally. So S&P 500, as you can see, has gone up for the past couple of weeks, as well as the advanced decline ratio, meaning the number of stocks that are advancing, followed by the number of stocks that are declining. So as you can see, it's a healthy bounce. One thing to keep an eye on, if this advanced decline ratio starts heading down before the stock market changes direction, meaning it can actually or almost mimically pattern give a pattern how the index would perform. So it's kind of like direct
Mark,
directly
is that
proportional.
excuse me, Mark, is that based on market futures?
Oh, these are just the regular, not futures, but the one that happened during that day.
Oh,
Not
okay.
future.
So
I
it's
wish I could have access to the futures, but yeah, I'm not
mm-hmm.
sure where to pull that information. But
Okay.
yeah, Dow Jones also, as you see here, it's very supportive, advanced decline ratios. The more stocks that go up, along with the stock market indices. So it just means that the index is not being pulled by just one stock or a couple of them, or the FANG stocks,
Mm-hmm.
as we would like to term. So this is a healthy rally, in other words.
Mm-hmm.
So we're seeing a good rally at this point in time. Interestingly, despite the Fed rate hike, the ongoing inflation mania, the runaway inflation, as I would
Mm-hmm.
say, ongoing conflict. So far, looks like the markets are being stable, except for Nasdaq. Looks like Nasdaq is still down in terms of advanced decline ratio, being pulled by
Mm-hmm.
some few big names out there for sure, which we're gonna take a closer look at in a little bit. So as you can see, back then we were at 45, negative 45 or somewhere around that. We're at still at negative 68 despite the rally for past couple of
Mm-hmm.
weeks. Um, as I would like to speculate, it should be around negative, a lot less negative, probably negative 55 if we were to follow a strong support of low of not low but of Nasdaq stocks. So at this point in time, we can easily assume that the big tech is running the show on the Nasdaq. If you have big tech exposure, congrats to you for sure, because it's pulling the market, the Nasdaq index, up. So this is the historical 10 minus 2 year treasury spread. So this is what the experts are looking, and this is why we have this graph here. So right now we're at 0.21% from a peak of more than 1%. So technically we haven't reached the inverted yield curve yet, which has predicted the past 7 recessions, even including COVID
Mm-hmm.
lockdown. So what's interesting is I've seen this post online that forward 10 minus 2 year yield, the one that's looking a year ahead, has gone negative, which is indicative that sooner or later our current 10 minus 2 year spread will just turn negative eventually. But nothing to fear. It doesn't happen overnight. Once inverted yield curve happens, except probably during the mid 1980s, it happened like right away, that the recession happened right away. But if you're
Mm-hmm.
going to look at early 19 or late 1980s, it took a few years before the recession happened, as well as the during the great dot-com bust. The inverted yield curve happened a year ahead before the recession, before the bust. During the great housing financial crisis, it happened somewhere in 2006 2007. The inverted yield curve happened, and then 8 and 9 we experienced a recession. And during
Mm-hmm.
COVID lockdown, I think it happened December, and we experienced a recession uh, probably around March. It's during when the National Bureau of Economics research announces that we're in a recession. So it's
Mm-hmm.
not like on an automatic panic sell everything that you have once there's an inverted yield curve. Just my thoughts. What do you think, Wawi?
Well, like I said a few moments ago, that it seems like the underlying bullishness of individual investors are evident in the recent rally,
Mm-hmm.
and that's after a very, you know, small correction made by the Fed Reserve on hiking their rate. And now
Right.
they're going to be more hawkish So we will have a bit more of a stopping power against that inflation. So we're seeing a lot of prediction of a 5 basis points, 50 basis point increase in the Fed Reserve rate hike. So it will have a little bit of impact on the rising inflation.
Mm-hmm.
Um, and we're probably going to see at least four uh, of these half 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 point. I mean half 50 BPS rate hikes. That's just my opinion.
Right.
If
And
not, if not, if the first two does not pull down inflation, then expect more in rate hikes over the year.
right. And then you know what? That reminds me. I found this website. It's provided by CME Group. It's a Fed Watch tool. So if we're gonna pull it up right now. That way we could jive in our thoughts into the future, compared to the experts what they think. So you're currently thinking that there are gonna be more hikes pretty soon, right?
Hmm.
So this one actually also as well kind of like takes surveys of what the Fed will do in the coming days or coming federal meetings. So this is quite helpful, and we're probably gonna add this moving forward as well. And it's good that you've mentioned that, Howie, because
Hmm.
we're not like fortune tellers here, but we do see, we try to at least anticipate what the market will do, or at least position ourselves, or more or less, well, not really position, but what we do is actually just sit tight and just
Hmm.
hold our investments. There might be a speculative bet every now and then, but that's not our like main agenda in terms of improving our returns and retirement portfolio, as one would say. So this one is from CME Group, which is really helpful. Good thing you reminded me about this, Bobby. So this is for the next meeting at May 4, federal meeting. Current target is 25 to 50 basis points. So recently we just started, Jerome Powell just rate hikes at 25 basis points, or 0.25%. So the probability in this chart right now, people are looking at 31.7% of a possible 50 basis point, 50 to 75 basis point hike. So no longer we're seeing 25 to 50 basis points here as a prediction. We're now at 50 to 75 basis points.
Hmm.
Um, Whereas, uh, let's see, a month ago, February 25th, there are actually people are betting even more, 63%. This was a lot higher just a month ago. People are thinking that the Federal Reserve would actually gonna deliver at least 50, almost more than half, thinks that the Federal Reserve would gonna hike the rates by 50 basis points. But now we're down to 31%, but 75 to 100. So experts are now jumping from 50 to 75 basis point hike possibility in May to 75 to a total of 100 basis points. 100 basis points is 1%, guys. So this is quite a peak, not a peak, but a jump. So if this is going to happen, well, who knows what's going to happen to our mortgage rates, which currently is at, the highest in the past couple of years at 4.95%. So just by 25 basis point hike, Jerome Powell was able, not Jerome Powell, but the Federal Reserve was able to spike indirectly, or influence the mortgage rates incredibly, because we're at as low as 2.75% with buy points in fixed mortgage rates 30-year at one point last year, but now we're at almost 5%. So that's an incredible jump. Oh well, what do you think, Wowie? More people not gonna be priced out of the real estate market nowadays, right?
Yeah, of course. So that's why I posted, questions about Section 8 housing. What's
Mhm.
going on there? Are we seeing more an increase in applicants for Section 8. Section 8 is basically, government help um, for renters.
Mhm.
And you, I just so looking at the market scenario, recently just invested a few of my hard-earned money on like company like Walker and Dunlop.
Mhm.
Um, they're investing in multi-family dwellings, and I think some of these apartments that help uh, accommodate people that have lower incomes to afford getting a home, getting an apartment. That company has been around since 1937, I believe. I think it's based in Maryland, and they're into lending, sorry,
Mhm.
and and funding new housing.
Like so they're more on the finance side. It's not like they're property developers.
They're also into property development,
Oh, okay.
investing in it. As you know, I'm also invested in Blackstone, which is also in that type of realm.
Mm-hmm.
You just have to see, who are making the solutions to the current problem. So we need cheaper housing or more affordable housing. Uh, who's gonna provide the funding for these? So you're looking at private equity investors uh, putting in their money for this type of uh, buildings.
Right.
Um, so that's my response to the current situation. I'm putting my money where
Mhm.
it's needed, and it's it. I mean, is a reactive investment is what I did. But if you want to be contrarian, right, you could stick to uh, your technology stocks and all that that's going
Mhm.
down right now, because eventually they're all gonna come up, right? So it also pays to be a contrarian to the current trend, because eventually the market will go up, things will stabilize, right? So
Right.
there's a lot of negative news, pessimism in the market.
Right.
But look at the companies that are trying to make solutions to the current problems. And
Blackstone is the largest money fund, right? Private. That's not private, but it's publicly listed, but it has multiple sources of investments where it puts their money. They have a lot of
yeah,
dry powder as well in the hundreds of billions.
yeah, it
So
allows me
that'll be a
to
good pick. Mhm.
have an exposure to private equity that I
Mhm.
won't get in the public market.
Right. Something to look forward to, I guess. We can take probably take an episode and dissect it more, where it's investment. But yeah, here I have the Google calculator, mortgage loan calculator. So before, I would just want to compare like how much the monthly mortgage payments would be now compared to a year ago. So for there's a house priced at $300,000, 30-year fix. Right now, Google is defaulting to 5.3% for some reason. But if we're gonna put the 2.75, the monthly payment will be around $1,400, say give or take. 4.95%, that will be $1,682. So 1,682 minus 1,4, about $282 monthly difference at this point in time, just because the mortgage rates have climbed up. Well,
Mm.
it's not gonna be easy for sure if the Fed keeps hiking the rates, especially for those who are like first-time home buyers. There are government programs like the FHA and all that, but just gotta make sure that the monthly payments will fit in your budget.
Yeah,
So,
let me
mhm,
give my personal experience on this. So I came
mhm.
here in the States in 92, got my first home mortgage in 96. Back then, my mortgage was 7.25%.
Wow,
So the
that's
only
really
thing
high.
that's well, right, it's relative. So the main factor right now that's rather different back then are the prices of homes.
Right. Mm-hmm.
Homes are really expensive right now.
Mm-hmm.
So your entry level is much higher compared to 1996. But just
Right.
a few months ago, I was kind of sore for getting a higher interest rate on my new mortgage. I had like a 3.83%.
Mm-hmm.
But now it's relative. Now, the interest rate for a 30-year mortgage is closing in at 5%.
Mm-hmm.
So I can't complain about my 3.83 now.
Right. 3.83 is a bargain if you're gonna take a look at
So
it right now.
so for the short term, it's okay. What we have to control are the prices of the homes.
And there's on our last episode last week, Redfin data shows that there is ever increasing global demand. I mean, not global demand, but housing demand in their index. So demand won't die down, and there's still gonna be bidding ongoing. And the primary winner on these kind of like deals are those who can offer cash at this point in time.
And who can provide new infrastructure that would be more affordable.
Right. So miscellaneous charts. Um, as we've been discussing, so we have a bunch of charts for you guys today. So I hope you guys are liking this. If you're still listening, please hit the subscribe and like button, as this will help our channel. For the miscellaneous charts, this is from Bloomberg. This is just a snapshot. It says this is now the worst drawdown on record for global fixed income. Worst inflation in decades is hammering fixed income markets. So the investors are dumping their bonds because, you know, as recently as a decade, of past 10 years, interest rates have just been going down, down, down. There's been ease of monetary policy, a lot less lower interest rates. So if with the inflation now near 10%, just by looking at ordinary, daily expenses such as gasoline, um, investors are now looking for more higher returns than just 2% or 1.5%. So they're dumping their bonds at the worst rate. Um, if you're going to look at the chart, we have experienced the peak. If I would be not mistaken, we have seen the peak back in 2020 when during the financing or the easing of monetary policy took place because of the lockdowns. So since then, the bond market globally has been going down in value. I think we've lost $2.6 trillion um, since then, which isn't a good sign for because bond investors are the investors that kind of like I would say they invest not just a billion here, a billion there, but they move by tens of billions of dollars. But who knows? But at this point in time, it's good to take note that we're experiencing a massive sell-off in bond market. So this is supported as well as with the Bank of America Global Research chart, as it says here. If we're gonna do a weighted year annualize for 2022, government bond for the world has now returned negative 18%. We're at the bear market. So this hasn't been reported or not being discussed widely, but it's something to look to closer into as investors are dumping their bonds. They're looking for better returns. So might be that they're gonna start moving into stock market, but stock market isn't as a safe haven as well because there's no guarantee in the stocks. Nobody can guarantee you that the stock will be up or down. Bonds, once they mature, at least you get to recover 100% of your investment. But regardless, we're at negative 18% for the global bond market, which is interesting.
I
Right?
don't know if we can have access to the bond buyer index.
Mhm.
It's like a daily index of the Mooney bond prices, um,
Uh, let's see.
like for municipal bonds.
Bond buyer indices. All right. While that loads, well, we're going to take a closer look. So,
Mhm.
nonetheless, despite the bond sell off, we're seeing a contrasting performance. Biggest winner, commodities, including oil, of course.
Mhm.
In this title snapshot, commodities jump most since 2009 as Ukraine war threatens supply. Crude oil jumps past 105 with Russia's isolation deepening. War is also choking grain supplies from top growing region. So Bloomberg Commodity Spot Index is at a record. So needless to say, it's commodities has been the best performing assets. So I guess we it needs subscription. Looks like Wowie. Maybe next time we're gonna subscribe
Mhm.
for the bond market. So US mortgage rate. So we just discussed this, where this was published maybe a couple days ago from Yardeni Research. 30-year mortgage 4.57%, while the 10-year treasury yield is 2.34%. They move in tandem, guys. If you're gonna overlap these charts, they move in tandem regardless. So now another miscellaneous FANG stocks, the big tech, Facebook, Alphabet. Oh, not Facebook anymore. Meta platforms. Meta platforms, Alphabet, Amazon, Microsoft, Netflix. So right now, the market cap of these companies as a share of the S&P 500 is at 21.1%. I believe when we started our podcast, we were at the peak while we last June
Mhm.
or May,
Mhm.
where it was around 20, 23, 24 times. So right now it's 21.1 times. Still big. Not as big as last year, but still big.
Mhm.
A forward profit margin, which is the better indicator if these big tech companies are holding up to their promise. One thing is that's outstanding here is Microsoft. The most profitable big tech company is Microsoft. Looking
Mhm.
at it 12 months ahead. The second most profitable is Google at 27.7. Microsoft is at 36% profit margin, keeping 36 cents out of the dollar. Google is keeping 27 cents per dollar sales, followed by Facebook or Meta, 26.8 cents. Regardless, Facebook is still selling cheaply. Disclosure, I'm an investor in Facebook for sure. Bought the dip, still in the red, but yeah, they're profitable. Pink is next one. So Microsoft, Google, Facebook, and then Pink is Apple, 26 cents, followed by Netflix at 16 cents per dollar, Amazon, 5 cents a dollar. Least profitable is Amazon at this point in time.
Mhm.
FANG, stocks forward price to earnings. Currently, we are at 27 times earnings. Price to earnings ratio for the next year. It's a lot less from the all-time highs of 2020 at more than 35 times. So FANG stocks have sold off for sure.
Mhm. And
Um,
that's why it may be good to look at equal weighted index fund
mhm,
to kind of level out your risk.
right. Spread out the risk and not be
Mhm.
overly exposed in one sector like a big tech for
If
sure.
you look at the small cap ETF IJR,
Mhm.
uh, it's showing us a slight uptick. So micro cap, well, I'm not gonna say, you know, if you look at smaller companies, is what I'm saying. You might
IJR. Mhm. Oh
you
yeah,
might
that's small
you
cap.
might see some improvement in performance.
Right. Oop. internet is a little slow, but we're gonna take a look at iShares, IJR.
Mhm.
Forward price to earnings ratio for the big tech. Who's the cheapest of them all? Obviously, Meta platforms or Facebook at 17 times. Second cheapest is Apple. Oh no,
Might
sorry.
be
Google. Google. Second cheapest is Google, 23 times.
might
Much
be
more
good
expensive the
good
market though.
entry point.
23 times. Oh, and Google will be splitting their shares, right, Huawei, by the end of May?
Yes. So just keep looking at the chart, and if you're if you have good conviction on Google, it might be a good entry point
Mm-hmm. So
before the
23
split.
times. Yeah. And then next cheapest would be no more cheap at this point. 27.5 times Apple. Microsoft at 29 times. And Netflix at 31. Amazon the most expensive at 60 times earnings.
Mhm.
Right. So for the financial conditions index, so we've been taking a closer look at this once every podcast. So we are close to negative zero point 0.2. So currently we've surpassed negative zero point 0.4. It's just going up and up since July 2021. So during the COVID lockdown, it was as high as positive 0. I would say 35. So we're closely going to neutral now. The conditions for the overall market, not just the stock market, but including also the daily expenses and usual spending habits of individuals here in the USA, has been tightening. And this is an interesting chart from Bank of America, which is supported by the JP Morgan chart that we have. So global earnings, something to closely look into, Awi, as globally companies are revising their earnings projections lower.
Mhm.
So much of the companies are probably expecting a lot less earnings at this point in time, which isn't a good sign if we're looking at growing companies. So this is JP Morgan global forecast. So inflation, their forecast globally is more than 1%, while GDP globally, gross domestic product growth, is down negative 1%. So this is quite worrisome actually, because if globally countries around the world would be delivering negative growth and inflation will be very high, that doesn't sound good for investment purposes. We're looking at a possible downturn instead. Oh well.
Mhm. Yeah, well, because of inflation pressures and pricing competition, there's gonna be these type of revisions. But you
Right.
gotta look at who's still investing, right?
Mhm.
Who still has trust in the U.S. market. Look at uh, well, I'm just looking at Statista
Mhm.
and looking at the foreign companies that are still holding U.S. Treasuries, and looks like China and Japan, as of September 2021, still were the largest holder. I don't have the most recent data, so it would be interesting who's still, trusting the U.S. Uh, Treasury.
Mhm. Yep. Well, now we're gonna take a closer look at the outperforming stocks of the week, at least for communications. AMC, I think we kind of discussed this in our group. Like the meme stocks are bouncing back. AMC is up 28% for the week, and if I'm not mistaken, GameStop is even more. For the past week, GameStop, let's see, recorded a 68.83 bounce. So crazy. Meme stock is back in fashion, looks like, but we're gonna see. We're not gonna hold our breath for that.
Mhm.
Um,
Well, I look at this, I'm smiling and giggling all the time when I
mhm,
see AMC, GME, because it just shows that, people are still playing the stock market.
Mm-hmm.
So I think it's a healthy behavior. Although, we look at it like, oh, they're crazy. What are they doing here?
Right,
But
because it's
but
it's
I
hard. Mhm.
I still look at it as a healthy, what do you call this? A healthy play in the stock market. Okay, so you have people, like us that will, try to like aggregate news and analyze things. And then on on the other end, there's this group that is just rallying, they're just rallying their members, their group,
Right,
and they're
through
driving the market.
through Reddit, and interestingly, Robinhood, where most of these people are traders in trade, is down -6%. So if people are buying, spending all that money, it probably is making Robinhood as well money, but they're down 6%. And Coinbase, which is another, crypto um, broker, is up 2.7%, which is interesting to take note of. So this is a screenshot from a Bloomberg article, an unusual tandem. So richly valued high growth stocks and real yields rise simultaneously, whereas it should be, or as often as not, inversely um, proportionate. So yields rise usually if there's a sell-off in treasuries, which is, which currently we're experiencing a sell-off in bond market, whereas growth at any price as well is rising. So probably some sprinkle of some funds flowing anywhere but bonds going into some richly valued, overly priced stocks. That's why what's happening. So next screenshot, this is from Statista. The link between soaring food prices and political instability is now at all-time high. So this is something to watch out for. Arab Spring happened in 2011 when there was a crazy inflation. Food price crisis riots back in 2008 during the Great Recession. We're at 138 right now. This is quite alarming for sure. All-time highs. But yet, we just saw the lowest job employment rate, right? We're now at where are we at in terms of jobless rate, unemployment rate? I think we're back in pre-COVID even.
Yeah, I think
So,
that I agree. I think the numbers are good. We have a tight job market.
so people are going back to not back to school, but back to employment. So I guess while the great resignation is over.
Hmm. Yeah. So because of they stopped the support,
Hmm.
and they're removing quantitative easing and
Right,
uh, employment support. I mean, wage support.
right.
Um, with regards to food insecurity, I think
Mhm.
uh, the twin of that would be, water security.
Hmm.
You- Area. So you have to look at geographic locations where water insecurity is also rising, and
Hmm.
that's where certain political instability will rise.
The drought, water is needed by everyone for sure. I think our body composition is like more than 80% water. I'm not sure.
Mhm. Can't survive without water.
Right. Unemployment rate, meanwhile, is the lowest in the past year, 3.8%. So the job market is strong. So I don't see, conflicting signs. Well, a little bit conflicting for sure, as probably most of the people who have resigned or who have participated in the Great Resignation has now decided to come back to the market in order for them to add their buying power, because right now we are at crazy inflation, runaway inflation. Yeah.
Mhm.
Random fact. Yeah. Body water percentage is between 45 to 60%. Almost half of our body comprises water. So we need water for sure. Meanwhile, Instacart. This is a privately
Mhm.
held company. cuts its valuation by nearly 40%. CEO of food delivery company says change reflects stock market trends, doesn't affect its plans to go public. Which, interestingly, these are the unicorns.
Of
So,
a few years ago, yeah.
yeah, these are unicorns that are over $1 billion in market capitalizations, billions and billions of dollars. And now they decided to write down their valuation by nearly half. So this just shows that the speculative mania in the private markets are almost done and over with. Also in this article, this is a Wall Street Journal article, by the way. Shares of DoorDash. So DoorDash is already publicly listed. It's down 22% from last year. Shopify is down 35% from last year. If we're gonna look at some widely known companies like Snowflake, maybe even Buffett invested in Snowflake.
Oh, really? Interesting.
Before it listed in the stock market, it's down. Like, drop. It's down. At one point, even it lost 60%, 58%. It's down 45% in the past year. So most of these companies, high flying companies, have been going down since they listed. Obviously, Coinbase down 43%, Robinhood down 64%, like flatlining here. Crazy. So I guess time is up as well for privately held companies to be, just asking for crazy high valuations. It reminds me of WeWork too. There's WeWork, right? At one point, they have a series now in Apple Plus. I wish they had put it in HBO, but I guess Apple won the bid. WeWork sharing of office spaces is down 38%. And this kind of skips the whole charade of the SPAC as well, SPAC mania. So those companies. So it just means that the investor sentiment is now kind of like focusing on the sure thing, like which companies is growing steadily, has stable profits, not much debt to worry about, and not going bankrupt anytime soon. So if you're a unicorn, or if you're a startup company, it might be harder to raise money right now. Kind of reflects that we're looking at the financial conditions index as well, since we've been tightening in the tightening mode at this point in time, where we're going to see like survival of the fittest in terms of the Fed hiking up rates all over the place, as can be reflected already in mortgage rates. So how raising rates can backfire. This is a Baron's screenshot. So this is another thing that we need to take a closer look into. Every time the rates started going up, let's see how raising rates can backfire. Inflation investment rate. So higher rates cause job losses. Oh, okay. So as increasing the Fed rate hike, as the Fed increases their rates, there's increase in job losses too. While lower rates spark inflation down here.
Yeah, so that's what, 74. So I don't know who's the president back then. I was 4 years old. Well, this perspective, if the government can produce jobs using the infrastructure budget, then that will stave off some of the job losses that will be potentially incurred by uh, higher rates.
Right. Well,
So
sorry.
yeah, so the government is a big factor here. If they can build new jobs, by using what fund is already available.
Right. Well, I think as long as the companies offer good salary as well, hopefully employment would keep on chugging along, and the employment rate would still be down. because right now, inflation rate and then the interest rate is increasing. So hopefully we don't see any job losses. That could be a detriment. Imagine buying a new house at higher interest rate and then losing your job. I mean, the only way
Mhm.
to get out of that is just walk away from and declare bankruptcy. But hopefully that doesn't happen
Mhm.
because that will give a tremendous shock, which already occurred back in the 0709 financial crisis.
Mhm.
So, so this guy is from Nuveen. So he says, sell stocks on inflation and Russia war. CalSTR's CIO Ailman says. No, I don't know if you're gonna follow his advice, but it's hard. When are you gonna buy? Are you gonna wait for a dip or what? Because if you're out, out in cash, you're just gonna be timing the market as a result. So it's hard to time the market, as we have already, experienced firsthand, and as we've, you know, take a look at in a case-to-case basis. Remember that janitor that we, uh, you know, r- you know, kind of like highlighted, janitor
Yes.
who retired as a millionaire.
Yes.
He had a very big portfolio, and what he does is like every paycheck, he just calls the company. He invests in them, sends them the check to buy their stock certificate on a like a routinely basis. So he doesn't time the market. He just keeps, putting money into it, slowly building it over time.
Yes. Yes. So the Japanese have a word for that. It's called kaizen, which
Kaizen.
is,
Uh-huh.
yeah, which is small incremental improvements over time.
Oh, that's very good. Change for the better. Continuous improvement. A little bit each time, which
Yes.
makes sense. So, wow, we're almost done with our charts, I guess. But so this is the rent chart. Um, Sunbelt metros like Miami, Tampa, Florida, and San Diego, California are the least affordable areas for renting right now, while the most affordable rental markets include Kansas City, Oklahoma, and St. Louis, Missouri. Nonetheless, new home sales have fallen below consensus in February. So there's a slowdown in real estate as reflected in the February report. And according to this realtor assessment, rents are going up. They're grow they're growing and going up
Mhm. A
compared to
friend of
last.
mine is trying to build a home, and he said the builder is pricing $240 per square foot.
That's like a mansion, 240 somewhere in New York or what?
Somewhere in Texas, somewhere in East Texas.
That's too expensive. Here it's around 195 to 105, whereas before you can actually find a house being built for 85 square foot. So
Mhm.
definitely prices have risen. So last part of our chart and sentiments and miscellaneous is this one. Auto sales are falling in the US, but profits are soaring. So retail automobile, according to JD Power, are forecast to fall nearly 28% this month. That's
Mhm.
crazy. 30% are going to be, you know, wiped out in terms of being sold, primarily because of low inventory. But they
Yes.
say that profits are soaring because of the
Mhm.
prices. So demand is still there, but
Mhm.
this is quite indicative of what can happen in the real estate market as well. Now, hopefully
Mhm.
it doesn't, but because it doesn't make sense. Sorry about that. Real estate, we have continuous growing demand,
Mhm.
whereas auto sales, these are big ticket items that can be postponed. You can still ride an Uber unless you're living in a country for sure.
Mhm.
So I guess
So
now
we
we're just, oh, sorry,
so we
go
can't
ahead.
be in we can't be in denial. We're already in inflationary phase.
Mm-hmm. Yes, exactly. Inflation for sure. Hopefully unemployment sticks around. So right now we're just gonna, going long on this podcast, but we're just gonna roll the clip on two interviews. One is from Wedbush, Dan Ives, conducted by CNBC, garnered 30,000 views, interview happened on March 23rd. It says here tech stocks are oversold. Now it's time to double down, according to Wedbush Dan Ives. For those who don't know, Dan Ives is a bull. He's also similar to Fundstrat's Tom Lee. He's always bullish on Apple. Let's roll the clip.
These higher rates were the reason we were concerned about technology stocks. Why are technology stocks up so sharply as rates have really started to climb?
That's right, Becky. It's been such a mind-boggling ascent. On the one hand, you have investors saying they're worried about a recession. The bond market seems to be flashing a warning sign. Some investors are saying, hey, do we have a stagflationary period coming? And then you look at the stock market and you're seeing tech growth just on a tear over the past 2 weeks. And some traders I was speaking to said, hey, positioning was so flushed out heading into the Fed event that some of these stocks were bound for a rebound, and also their valuations have come down a ton. You're seeing some of the biggest stocks in the entire market, some of the FANG stocks down significantly on the year. So I think that's led some investors to come in and kind of look for bargains and say, is this sell-off overdone?
And I know that's your perspective. You do think that this is a really good buying opportunity. Where especially would you tell folks to be focused?
Look, I think tech stocks are as oversold as we've seen in the last 5 to 6 years. And I think last week, that's when the Band-Aid got ripped off, the green light to own tech. I think names like Apple, Microsoft, you look at cybersecurity, I think it's a golden age for cybersecurity, names like Zscaler, Palo Alto, and others. In our view, from here, tech stocks are up 20, 25%. I can tell you investors 4 to 1 calling us, looking for buys versus sells. That was exactly the opposite if I go back 2-3 months ago.
Hey, Dan, correct me if I'm wrong. I don't remember you having too many times when you haven't liked tech stocks, when you thought, okay, this is a bad time to buy. Am I forgetting times that we've talked about this and I'm just not thinking of it?
Oh, no, look, I mean, I'll be clear, we've been perma-bullish for the last 12 years in tech, which is why I fundamentally view these as opportunities. When you have sell-up, that's when you get what I've used the high quality transformational names like Apple, Microsoft, Amazon, and others. And I think that's sort of been our philosophy in these times of chaos where the haters are hating and and fire into a crowded theater. And you look at some of these valuations, that's the time to double down on tech. And that's where we see ourselves today.
So for him, he's been a perma bull for the last 12 years. It's been good for him because he's been bullish.
He noted down some very good companies on my radar.
Sorry about that.
Yeah,
So-
well, the slide that was presented on that video shows some very good growth companies.
Mhm.
Palo Alto, CrowdStrike, Okta, Fortinet. Yeah, it would be good to put on your watch list if I were you.
Right. And I think Okta just suffered a massive, what do you call that? Cyber hack too.
Mhm.
Because I think Okta kind of like is the software that kind of gives user automatically saves his username and stuff and password when logging into a corporate system. So that
Mhm.
way they don't have to type in all over again. But
Yeah.
they themselves got
Mhm.
hacked. So
Mhm.
that's quite an indication there of lapses, security lapses on that company. So
Mhm.
for sure, we're gonna roll the clip whenever we see this guy's name for sure, because he's the chief investment officer of Morgan Stanley,
Morgan Stanley. Mhm.
one of the biggest and well-known Wall Street firms in the field of investing. So this says healthcare is a good place to invest, says Morgan Stanley's Mike Wilson. 20,000 views recorded on March 22nd. Let's roll the clip.
Hey, Mike. So the record of soft landings engineered by the Fed is actually not great. So 1965, 1984, 1994. I think in all cases, we had a great demography and we had a roaring economy. And the soft landing was really just about trying to prevent inflation. This is a very different situation. Inflation is here. It's worse than anyone on the board expected. It seems to be caused by things other than the economy, which is a little bit tougher for the Fed to address. Why do we think this this attempt at a soft landing will be successful where so many others failed and recession became the result?
Yeah, look, I'm not opposed to a recession potentially happening. Quite frankly, I would strongly suggest that we need a recession. Okay, we need to curtail demand. I've always said that we don't have a supply problem, we have a demand problem. The reason we have inflation is we overstimulated the economy. We created excess demand that led to, the surge in prices.
Well, we have both.
Well, okay, but we're producing way more stuff than we were pre-pandemic. Okay, it was a demand problem. We can debate that another time. The point is that if we got a recession, it would alleviate a lot of the inflationary problems. I don't think the Fed's going for a recession. Okay, let's put it that way. Will they be successful? I don't know. It doesn't matter to me though, Josh, because at the end of the day, earnings are still going to slow and the price is wrong. So I don't think we need to make a bet on a recession at this point to say that there's downside to the S&P 500 from 4,500. And that's sort of the point. I'm not trying to solve every puzzle out there. I'm trying to solve a puzzle that I can fix, and I know what that is. Is that the price is wrong. So let's just get that right first, and then we can debate whether or not there's going to be a recession.
Pete, you got a question for Mike Wilson?
Yeah, Mike, thanks again for coming on. I know it's always difficult, but I will ask you this. So you talked about individual
I mean,
names.
it's
I know
always
you won't
difficult.
talk
Why is
to
it
me
always
about-
difficult? What are you talking about?
Well,
It's always difficult. What's
he gets a
difficult?
hard time for me. He gets a hard time for people. But Mike, very seriously, the individual names, like you mentioned that earlier when you first started. I'm curious. I know you can't go over the individual names, but what sectors? Is there a specific area of the market, maybe 1, 2, 3 sectors that you'd say, you know what? Our economy's this, we're going to see a lot of pressure to the downside, but this is an area that I think you can actually is investable. Is there a specific sector you'd point out?
There's several, Pete, and thanks for your comments. I think healthcare looks extremely attractive from both a valuation perspective, and that's an area where there's pent up demand. It's also defensive, which is in line with our general defensive posture. Okay, and look, unfortunately, this war is terrible, and we all want it to be over. But there are some structural changes that are going to result from it, even if it ended tomorrow. There's going to be more spending on probably energy services. There's going to be more spending on defense and national security. And there will be software security as well. So those are new trends that are just emerging here right now, and really just the inflationary trends that we're going to see in materials. Right, we're taking off a lot of supply permanently, regardless of the outcome of this conflict.
Ooh. So he wants a recession, although he thinks that the Fed won't do it, and he's more of like for the healthcare sector and software, software security and stuff. What do you think, Bobby?
It's wonderful how he thinks about it. So I'm always thinking, oh, it's a supply problem, but he's saying it's a demand problem, which is probably correct because we have a lot of M2 supply, and there's a lot of dry powder there for people to buy goods and stuff. So he's on top of it, sounds like.
Yep. Looks like he's gonna be hopefully more of on the defensive side of things by the looks of it. Regardless, but he doesn't think that there's gonna be any recession just yet. So it's more of like probably preparing your portfolio for a possible downbeat and always be ready. Right. Well, Wally, do you have any quote for the week for our listeners?
Yes, I do.
Nice. All right.
If everybody else is doing it, I don't want to do it.
Just
might
go
be good to-
contrarian.
Yes, that is from Ned Johnson. God bless his soul. Rest in peace. Fidelity's Ned Johnson.
Right. Well, it kind of like gives a reasoning behind. Just a month ago, we were, in terms of the sentiments of our stock market, we were really trading at lows. And if you have sold at that low bottom point of the American AII survey, you would have missed this run that we just had in the past couple of weeks. So, stay the course, I guess, Wally, right?
Yes. Have
Well,
to.
yes. Well, Wally, thank you so much for coming on this
Thank you.
Sunday morning. Thank you, sir. Listeners, that does it for this episode of Marky and Wowie Show. If you have any questions, send us an email at markywowieshow@gmail.com. Remember, build that emergency savings and invest the rest for an abundant retirement. This is Mark Yu, signing out.
Bobby Santos signing out.